Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMB in Manhattan. Welcome to our weekly options lesson. I'd like this week to talk about a very important topic, which is risk management on iron condors, and specifically an advice I give to all my mentoring students, which is that you need to have contingent orders in on your trades, particularly if you are not around during the trading day. But even if you are and you are trading actively, it is imperative that you have contingent orders in on iron condors, and I want to show you why. What's an iron condor, first of all? An iron condor, just to refresh your memory if you have some knowledge of options trading, is it's a bearish call credit spread combined with, and that's above the market, and a bullish credit spread on the put side, put credit spread, and that is that's placed below the market. So essentially you have a position that brackets the market. So if the market expires anywhere between the short put and the short call, you get to pocket the entire credit of the iron condor. That's sort of basically how an iron condor works. So let's take a look at an example, and then we'll get into why I want to discuss contingent orders today. Let's say you wanted to put on the Russell 2000 index options, which are cash options. Suppose you wanted to place an iron condor for the Russell 2000 70 days out on January 10th, and you wanted your short strikes to be below 10 deltas, and so you ended up at 1260 as your short strike on the call side, and on the put side you're at 1040. And so that day, if you were to enter that condor approximately, these are hypothetical prices, but let's just say approximately, you would have gotten about 58 cents on the call side, and you would have gotten about 90 cents on the put side if you placed the trade about this time of day on January 10th. So the most you can get out of that trade is that credit you receive originally. Good risk management of an iron condor dictates that when the credit spread is down to about 10% of the value you sold it for, in other words, it's shrunken in value, meaning you're up money on the credit spread, that's a good time to take it off. Why? Because at that point, there's virtually no profit left in the credit spread, but there's plenty of risk left in it. If the market reverses and starts charging towards your credit spread, all of a sudden it's going to blow up in value, and all that profit you got from it shrinking down, all that's gone, and then some in certain cases. So what you want to do is put in an order, and here's the key of today's discussion. When you put on an iron condor, the best practice is to put in an order to buy back that credit spread for 10% of the value if it's reached. Now, so in the case of the call credit spread that we are talking about here, that would be when it's down to about a nickel, and for the put credit spread it's down to about 9 cents. Typically the put credit spread will be a little bit more expensive when you are paid for it, and a little bit more expensive to buy back. So therefore, the best practice is to go and put those orders in the day you put the iron condor on. Then you don't have to think about it. And why is it important that you don't have to think about it? And the reason is because if the market rallies and you can take off the put side, typically a market will rally and then there will be some kind of a profit taking or sell off after that. Or the market will sell off and there will be a rally based on valuations typically at some point, in which case you could take the call side off in the case of a sell-off first, and then take the put side off when the market bounces and rallies. And so in the perfect iron condor month, typically the market's going to go in one direction or another, and the credit spread on the other side of the market is becoming more and more profitable for you. You want the order to close that side to go off automatically, and that's what a contingent order will do for you. So in the case of this March condor, for example, you should have an order in for a nickel for the call side and an order in for 9 cents for the put side, and that order should go in a couple minutes after you initially enter into the iron condor, even though it may not be triggered for 30 days, 40 days, 50 days. But if you make it a good to cancel contingent order, which every broker has, then you would have the ability to have that order go off automatically without you having to think about it. Why that's so critical, we're going to show you an example of that. Let's take a look at this condor. In this case, about a month later, on February 5th, the condor, the market had sold off. And look what happened to the call side. The call side at 4 p.m. on February 5th got down to a nickel. So that would mean that the that the call side options would be closed automatically. The broker's order of a nickel most likely would be triggered in the marketplace, and so the call side is gone. Now, why is that so important? Because when the market was selling off, most traders are focusing on the risk of the side towards which the market is pushing and blowing up the value, in this case of the put spread, causing that side to become unprofitable. They're not even thinking about the good thing that's happening on the call side. But if you have a contingent order in, the broker automatically triggers that. And why that's so important is, take a look at what happens next in this example. The market rallied, and it rallied hard. And if that call credit spread had not been triggered that day, then it may never, you may never have gotten that opportunity again to get that call side off for a nickel. But now you're breathing easily as the market is rallying because you no longer have an exposure to the upside. You only have a downside exposure coming from that put credit spread. With the market rallying off of that, you can scalp the put side too. And that's what happened on March 4th. The put side got triggered. It got down to about 9 cents, and we just pulled that off also. So what's the moral of the story? When you're trading iron condors, you shouldn't have to think about the side that's not being threatened. You want your broker to just take you out of the risk on that side when it's most advantageous to you. That way, the broker does the work for you, and you don't have to, you can concentrate on the risk management on the side that is being threatened, because you may be wanting to roll the side that's being threatened. You may have a lot of different adjustment potentials for that side, and if you don't, if you're paying attention to that, the last thing on your mind most likely is the spread that's becoming profitable. So you want that efficiently, automatically taken off. Interestingly, if you have an iron condor month that goes very well, the broker does all the work for you. You put the order in, and then you put your contingent orders in, and the broker basically scalps the sides that become profitable for you, and you walk away with your credit in the case of what I would call the perfect iron condor month. So that's just a good practice. If you're an iron condor trader, get those contingent orders in early. Put them in as good to cancel orders at roughly 10% of the price, and you'll be very happy if the market does what it normally does, which is shoots so far in one direction, gives you an opportunity to scalp one side, then takes off in the other direction and gives you an opportunity to scalp the remaining side, and you can close your iron condor at a very nice profit. So that's a lesson for the week. If you have any questions about it, just shoot me an email at sfreudberg@smbcap.com. Be more than happy to answer it, and we'll see you next week. Thank you. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.